Hey there, it's Mortgage Monday, and today's Mortgage Monday is how to get a loan when you don't qualify based on your tax returns. In today's Mortgage Monday, I wanted to cover a common problem faced by many business owners, especially new business owners, in qualifying for a mortgage. Whether you're trying to purchase a home or purchase an investment property or even just refinance, this thing that I'm going to share is a stumbling block, a big stumbling block at that. So what is it? Your tax returns as proof of income. So you or someone you know have losses due to tax deductions on your tax return because you're either a young company or even a startup company. These are legal deductions, but lower your income on paper at least, making it difficult to qualify for a loan, or maybe even impossible to qualify for loan. So maybe you're even an established business and that in the last 2 years you invested heavily in the expansion of your business, or maybe buying new equipment, maybe beefing up your staff, and now you're reaping the rewards. But getting a loan, we look back in time. So we look in the rearview mirror, the last 2 tax returns in conventional lending, and that doesn't look so good. So you, in order to get a regular mortgage loan, those 2 years, you don't want to wait those 2 years. In today's day and age, that would mean that you would have to wait for your 2018 tax return, your 2019 tax return, and maybe you don't want to wait till 2020 to buy a home. So because of that, we know that it's a common problem. Over the last 20-some years, I've specialized in helping business owners get mortgages despite tax returns that don't show enough income or don't show stable and high income. So what are these alternative sources? They're investors who help us with this. They're called non-QM lenders. And so what are these solutions? So solution number 1 is asset-based lending. So that means that if you have enough money in mutual funds, CDs, IRAs, 401ks, we can use the value of those assets, excluding the down payment and closing costs, if it's a purchase, to qualify you for the loan. So if you're buying a home for $700,000 and you're putting 20% down, which is $140,000, and maybe you need about $10,000 in closing cost money, so that means that we need about $150,000. Most probably, we will need about $500,000 in assets to qualify you. We do have another investor who will lend as much as you have in the bank. So it's another different type of asset lending, but what they do is they lend you as much as you have in those assets. So if you have $700,000 in assets, they will give you a mortgage of $700,000. So that's another good way. So solution number 2. So number 1 was asset-based lending. Solution number 2 is asset depletion method. So the asset depletion method is similar. We look at all the assets that you have between 401ks and IRAs, CDs, mutual funds, cash in the bank. We calculate all that up, add it all up, minus the down payment and closing costs if you're buying a home. If you're refinancing, then we don't have to do that. And so with the asset depletion, it's kind of like amortization. We're using a certain time frame of 30 years or 15 years, depending on what the mortgage time frame is, and we're calculating out like your mortgage payment. So it's the opposite though. So we're taking that asset and depleting it over time. We're not actually taking the money out. We're not involved in your bank accounts. We're just using a mathematical formula to figure out how much income would that asset produce over 30 years. Some of our investors use 4% return. Some of them use and slowly deplete that asset based on you earning 4%. Some just deplete the asset with no interest credit. So that number 2 one was called the asset depletion method. Solution number 3 for business owners is the bank statement deposit program. And that's a fairly new program in the last 3-4 years. And what this is the number 3 solution here is to use either 12 months of the deposit in your bank account, your personal bank account, and average those, or 24 months of your business bank account. Because some of my clients who are business owners only deposit money in their business bank account and put very little in a personal account, just the minimum that they need for daily survival type bills. So daily living expenses. So either 12 months of the personal account or 24 months of the business account. We average that, and then we give you we calculate your debt ratio based on that. So no tax returns are ever provided, no bank statements, no tax returns or no pay stubs, just your bank statements. And we also have one program that uses just one bank statement. Okay, so now for investors, we can do those programs, but for investors, we have a loan. Solution number 4, especially for investors, we use the cash flow of the property. So no tax returns, no bank statements, no nothing, just kind of like in commercial lending, will the property sustain itself? So for example, let's say you're buying a fourplex that grosses $4,000 and the mortgage and tax returns are $3,000, or tax as insurance are $3,000. So we call this debt servicing, debt coverage ratio, sometimes they call it. But basically it's a commercial approach to residential lending, saying, hey, if the property can sustain itself, you can have the loan. So that's perfect for people who don't qualify with their tax returns but still want to invest in property. So that's it for this week's episode of Mortgage Monday. If you know someone who might be able to use some of these solutions, please introduce us, because I can help get a mortgage for them. And if you want to be part of our mailing list for free events, including Women in Investing, which is coming up in March, you just email your address to 444-999 and type in both your email address and keyword mortgage fun, and you'll be added to our mailing list. And next week's topic is how to eliminate or avoid PMI if you're buying a house or refinancing, even if you only have 5% down. Thanks for joining me for Mortgage Mondays, and I'll see you next week.